Welcome to our lecture series in financial management. Today we will talk about portfolio diversification. Diversification is one of the most fundamental principles of financial portfolio management. It refers to the practice of spreading investments across multiple assets, asset classes, industries, or regions in order to reduce risk without necessarily sacrificing expected return. The core idea behind diversification is simple. Do not put all your eggs in one basket. Diversification is not about eliminating risk entirely, but about managing and reducing avoidable risk. It reduces avoidable risks, smoothing returns over time. Investing in a single asset exposes an investor to large fluctuations in wealth. Diversification helps smooth portfolio returns over time. Key benefits of diversification includes reduces overall portfolio volatility, lowers exposure to firm-specific risk, improves risk-adjusted returns, and protects against unexpected negative events. An investor who owns only airline stocks will suffer heavily if fuel prices rise or travel demand falls. A diversified investor holding airlines, technology, healthcare, and bonds is far less exposed to any single shock. Diversification distinguishes unsystematic from systematic risk. Unsystematic is firm-specific. It is unique to a specific company or industry. For example, management failure, recalls, and lawsuits. Systematic is market-wide. For example, recessions, inflation, interest rate changes, and pandemics. Diversification can significantly reduce unsystematic risk, but it cannot eliminate systematic risk. Diversification works because different assets respond differently to economic events. It uses imperfect correlations. When one asset performs poorly, another may perform well. Portfolio volatility usually depends on how assets move relative to each other. For example, stocks often decline during recessions, but government bonds often rise during recessions. Holding both stocks and bonds reduces overall portfolio fluctuations compared to holding only stocks. One of the simplest forms of diversification is holding many different stocks. Most of the benefits of diversification are achieved with 20-30 well-chosen stocks. Diversification across industries protects against sector-specific shocks. During the COVID-19 pandemic, travel and hospitality suffered. At the same time, technology and healthcare performed relatively well. A diversified portfolio across industries performed far better than a concentrated portfolio. Asset class diversification is one of the most powerful forms of risk management. Major asset classes include stocks, bond, cash, real estate, and commodities. For example, a portfolio that contains 60% stocks and 40% bonds would be much more likely to be less volatile than a portfolio that contains 100% stocks. International diversification spreads investments across countries and currencies. Benefits of international diversification include it reduces country-specific economic risk, it provides exposure to different growth cycles, and it reduces reliance on a single economy. For example, when the U.S. economy slows, emerging markets or other developed economies may still experience growth. Correlation measures how assets move relative to one another. Correlation value of +1 means assets move perfectly together. Correlation value of -1 means assets move in opposite directions. Correlation value of 0 means the assets have no relationship. The key insight is that the lower the correlation between assets, the greater the diversification benefit. For example, stocks and long-term government bonds historically exhibit low or negative correlation during market stress. There are several diversification myths and mistakes. For example, some people believe owning many stocks guarantees diversification, but this is not always true. Another myth is that diversification eliminates all risk, which is also not true. Another diversification myth is holding similar ETFs ensures diversification, which is often false. For example, owning 5 technology ETFs may look diversified but still exposes the investor to the same underlying risk. Over-diversification occurs when adding more assets no longer reduces risk meaningfully. There are many problems with over-diversification. For instance, it dilutes high-quality investments, it increases complexity, and it raises monitoring and transaction costs. The goal is efficient diversification, not maximum diversification. Exchange-traded funds, ETFs, and mutual funds make diversification easy and cost-effective. For example, broad-based ETFs may help with efficient diversification. These include total market stock ETFs, international equity ETFs, and bond market ETFs. These instruments allow investors to achieve instant diversification with a single investment. Apply efficient diversification principles for resilient portfolios weathering fluctuations. Thank you for watching our lecture on financial management, focusing on portfolio diversification. See you at the next lecture.